Hey, everybody. Welcome back to the Work Hard, Invest Harder podcast. I am your host, Justin Dixon, and I'm super excited about this episode. I've got my friend Josh Plave on the other line coming up. He's niched himself down in helping people how to take their old 401ks from a previous job and use that as an investment vehicle to passively invest in multifamily real estate. So if you're sitting there in a job and you had a previous job with an old 401k and you're not sure what to do with it, this is a perfect episode for you to listen to kind of realize what you can do with that money. We also talk about a good first step in your real estate journey. There's a lot of aspects of real estate out there, whether you want to invest in multifamily or Airbnb or fix and flip, but to really pick one of those areas and really focus, become a master of that skill. So let's jump into the episode and talk with Josh.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, everybody, welcome back to another episode of the Work Hard, Invest Harder podcast. I've got Josh Plave on the other line here now. So, Josh, thanks for coming on the show, and let's jump right in. Tell us a little bit about you and your story and how you got kind of started in real estate.
Yeah, thanks, Justin. Really excited to be here. So I got started, about 5 years ago. So I got started from the retirement standpoint of things. That's kind of what we're talking about today. So I guess I'll take the story back to when I was a teenager. So I started using retirement accounts when I was about 16 years old. I had worked a summer job, and my mother and my grandfather were both CPAs. So they start looking out for your future and putting some of your, your income towards retirement. So I opened up a Roth IRA at that time, and fast forward about 10 years from then, and both my mother and grandfather, who I had mentioned, had both unfortunately passed away. And so what they did was they left myself and my sisters with their retirement account specifically. So it wasn't like a life-changing amount of money, but it was enough that I needed to make sure I was going to be a good steward of everything they'd worked hard for, and make sure I understood the proper vehicles I could use to invest in something that was smart, long-term, could grow the wealth into generational wealth. So I started looking into self-directed funds, which we're going to be talking about, but that ultimately led me into real estate when I realized that I could use leverage within them. And so I started looking at all different types of real estate avenues when I was transitioning my career. Ultimately started actually with multifamily. I decided to skip the whole scaling up process, jump straight into multifamily specifically, and have been loving it ever since.
So talk a little bit about how that because a lot of people that I talk to, when I started in 2 to 4 unit kind of space, I skipped a single family. But a lot of people start, or they feel like they have to start in, smaller deals, single family, fix and flips, or, you have a primary residence and you buy a beach house that you rent out. How did you kind of just say, okay, now I'm going to skip all that stuff and just jump right into multis?
Yeah, so I had actually seen a couple presentations on multifamily. This was probably 8 months into my real estate journey, where I thought I was going to wholesale or flip or something. Okay. I was trying to get a feel for it. And right before I started pulling the trigger on that kind of stuff, I saw a presentation on multifamily and realized they were saying, hey, it doesn't matter. As soon as you hit 5 doors, it's a completely different lending process. And there's a lot more pieces involved. And it's really just a question of how many zeros are at the end of the transaction.
Right.
So you just need to figure out, you already got the teams in place. You just need to essentially raise more capital, involve more professionals to execute the business plan. But it's roughly the same. So it was that kind of light bulb moment where I realized I don't necessarily need to start with 2 or 4 or even 5. Once I hit 5, I might as well start looking at 90 or 100 or 200 unit properties.
Yeah. And that was my thought process was, let me start at 2 to 4, because it is like buying a single family house, right? The lending process is exactly the same. Yes, it's an investment property, but, and also the numbers are smaller. So I felt like I could bring my own capital to the table as opposed to going after a 100-unit apartment complex where, I wasn't financially well enough to do it back then. And so I had to like build a team. So were you a full-time employee as you started your real estate journey, or how did that, and then, let's talk a little about kind of your transition away from, the W-2 and all that.
Yeah. So I actually was sort of fortunate in the way that it played out. I was wanting to transition out of my current job. I was doing big data analytics essentially for different Fortune 500 companies. So I was sitting in Excel all day, different spreadsheets and stuff like that. So when I started looking into real estate, I actually at my work had gotten a notice that they wanted to move my job. I was living in Denver at the time. They wanted to move me to Plano, Texas. And I love skiing. I didn't want to leave Denver, Colorado. So I decided I was going to stay. And what they did was they actually provided us with some severance. And so that gave me the opportunity to transition into multifamily at that time. So when I did that, started raising capital, was able to kind of jump into deals, was able to use some money we had for earnest money as well, getting involved in different parts of the process. And earning an income that way. Certainly wasn't, I'm not going to sugarcoat it. I wasn't replacing my income at that time with what I had, but it was giving me a lot more time freedom and ability to, I had to live off of some savings for a bit, but it was giving me the opportunity to really focus on something that was going to enable me to grow my future and hopefully retire, early.
Yeah. And if you wouldn't have had that kind of job change in the sense of having them say, hey, we're going to move your job, if they would have not done that, do you think you would have still made the transition, or was that kind of your ultimate goal? How did you kind of think about that?
I would have made the transition at some point. It would have been delayed. That's for sure.
Got it.
Because that one little moment definitely kicked my ass into gear.
Got it. No, that's fair. And there's always this mindset shift. And mine was kind of walking to work one day. I read Rich Dad, Poor Dad, and that was like the trigger moment for me, right? Did you have that moment, or did you kind of like grow up with a little bit of real estate in your kind of blood, and then you started just like, hey, this is a cool option. I need to dig in more.
I grew up with zero real estate in my blood. I'd always had an interest in it. As a kid, we always we did different house tours and stuff like that. So I was always interested in investment properties. I don't know. I had a moment earlier in my career. I went to a school where we actually went to school for 6 months and then we went to work for 6 months. And so instead of a 4-year school, it was a 5-year school. So I was working full time from the age of 19 on essentially. And so I learned very quickly that the office life wasn't necessarily for me, and I wanted to kind of forge my own path. So that moment is distinctly in my mind. I don't need to get into like full details or anything, but it definitely happened years prior. And that's kind of when I started looking to what my options were while I continued the career I had.
Got it. So let's catch up a little bit on what you're doing now as far as it sounds like you're on your own, you kind of have your own business. So maybe talk a little bit about that. And then, where you are kind of in your journey, because it sounds like you've been on that path for a few years now. So, was it like a rocket ship straight up, or, kind of how did that evolution go?
Yeah, it's been an interesting process. When I jumped in running acquisitions and finding deals myself, underwriting and acquiring the properties entirely. So realized quickly that, and I will at some point grow this ability of mine, but I'm kind of introverted. I'm not the best at networking with brokers and everything. So I realized that wasn't my strong suit. And when I developed this knowledge surrounding retirement accounts, realized I actually had the ability to pass that on to other people. I was finding the information it took me almost 2 years to gain the full knowledge that I've got on the space. And it was piecemeal. I was finding things here and there and all over the place. So I realized I could kind of coalesce it down into one specific kind of lesson, essentially, and share that with folks. And so when I did that, I had a point from which I was able to actually educate people and then offer them investment opportunities that align best with retirement accounts. And that's really where I started to see my success. I was able to kind of talk to a specific type of person who, they might have had old retirement accounts from past jobs just kind of sitting around. Or maybe they weren't happy with the investments they had, and they wanted to transition into something like a hard asset. So, it kind of provided that nice talking point to talk to investors, and it certainly wasn't an overnight success, but it actually was. It was an easier in with investors to be able to speak to them on a specific level. A lot of the times you kind of got to search hard to find who your audience might be. Yeah. And that kind of came fairly naturally, thankfully, at the start of it.
Awesome. So I'm going to ask a real important question right after this sponsor break. So stay tuned and we'll be right back.
Whether you're in a job you love or hate, building a financial foundation is important. This foundation can support you by providing passive income, stability in an uncertain economy, or the launching pad for you to start your own business. Great Venture Capital helps busy professionals invest in commercial real estate to build passive income streams, grow wealth, and take advantage of tax benefits. If you'd like to learn more, check us out at greatventurecapital.com or send an email to justin@greatventurecapital.com.
All right, we are back with Josh on the Work Hard, Invest Harder podcast. Just before the break, I said I had a really important question to ask him. And so, you talked a little bit about people can invest with their retirement vehicles or an old 401k. So can we break this down a little bit, get a little nerdy, and talk a little bit about taking, let's say you worked at a job for 5 years prior, and that 401k, you didn't roll it over into your current W-2 401k program, right? So it's just sitting there, it's kind of ebbing and flowing with the market. You're not able to contribute to it. And so, how do you gain access to that capital to invest without the penalties of, taking access to the cash early, right? So maybe talk to that a little bit more in granular detail, because I'm sure I didn't realize that when I was starting my investment journey. You actually helped me on some of that early on, because I had 2 old 401ks from previous jobs, and I was like, well, this is just sitting there, and I can actually now invest and start my real estate journey because I didn't have the actual cash asset, but I had these retirement accounts. So talk a little about that.
Yeah, absolutely. So Justin made a great distinction here. So, if you're thinking about your retirement accounts, you might have one in mind, you might have a couple in mind. The important distinction is it needs to be almost entirely, in most situations, it needs to be an account from an old employer, or maybe like an IRA that you establish yourself on the side. If it's a 401k at your current employer, usually most of them won't let you take what's called an in-service rollover and remove the funds from their administration. So if you have old ones sitting around, the process to get started is really simple. You already have total access to that capital. It's different for every custodian, and some make you jump through hoops. Some make the process pretty easy and streamlined. But essentially, you're just asking to roll it over to a new custodian. So you can roll it over.
A custodian is like a Fidelity or a Vanguard, right? Those are the people that have the actual asset, right?
Exactly. Yeah. So like if you've got an account at Fidelity, but then most of your banking is done at, let's say, Vanguard, you just ask for them to roll it over from Fidelity to Vanguard. Now with a self-directed retirement account, you open up, and we'll get into it. You open up an account at a different custodian that offers alternative investments, and you would be rolling it over from the old 401k. You can roll it over directly to that new custodian that you're ultimately going to use.
Got it. And so if I go through that process, what type of investment, are there different types of self-directed IRA custodians? What are the benefits of either? And then how do you then, if I find a deal, let's say I bring a deal to an investor and they've gone through the steps of the process to take their money from their old 401k into a self-directed, how do they then deploy that into that asset or that deal?
Yeah. So I'll start with what you can invest in. And essentially, when they created the retirement accounts, they didn't say what you can invest in. They just specified a few things you can't invest in. So you can't actually invest your money into collectibles like art, jewelry, cars, alcohol, stuff like that. You can't buy life insurance policies, and you can't invest in S corporations. Okay. Outside of any of that stuff, you can invest in anything you like. So I think real estate actually lines up pretty well with it. But what you ultimately do, there's really 2 different types of accounts that you can use in the end. There is a custodial account, and there is a checkbook control account. Now, they both start with the exact same first step. As I mentioned, you roll the funds into a brand new account at a custodian. And there's plenty of custodians out there. There are some that are really good and there are some that are really bad. When you find one, you likely should, if you haven't found one through Justin or myself or someone in the space, you should ask around. A lot of people know which ones are really slow in their communications, which ones are on top of it and provide good services. But yeah, so you'll roll it over to that custodian. Now, a custodial account will keep it there at that custodian and you'll be interacting with them entirely. So if you have a new deal, then you would bring the deal information to the custodian and they would have to approve all the paperwork. You run all the paperwork through them. And that's really where the process can slow down occasionally if you're not with a good custodian. Some custodians can process these things in 48 to 72 hours. Some of them I've seen take 3 to 5 weeks, and we've seen investors lose out on opportunities because of it. So yeah, you really want to make sure you're with a good custodian. The one main drawback I see to the custodial process is that they actually have a very, I guess that you could call it a progressive schedule of fees. So if you're doing a great job of investing and you're growing your account from 100,000 to 500,000 to $1 million at some point, they start to charge you more based on the assets that are held in the account, even if they're not there physically at
even if they're deployed elsewhere.
They're just keeping track of maybe your 3 or 4 different investments. They're still charging you more. So there's this other concept I talked about called checkbook control. So if you do a checkbook control account, you'll, as I mentioned, do that first step of moving it to the custodian. But at the same time, and you're typically going to be doing this with a service provider who can, like a vendor who can do this all for you.
Yep.
They'll open the custodial account. At the same time, they'll open up an LLC for you that is owned directly by the IRA, the new self-directed IRA or a solo 401k. And they will take the funds directly from that retirement account and move it into the LLC. The LLC will be wholly owned by the IRA. And from there, you operate it just as you would with any other business. If you haven't operated a business, it's pretty simple. It's no different really from your own personal account. You just have a separate bank account for this new business. And you don't have to communicate with the custodian every single time you have an offering. So if you have a new deal with a checkbook control account, what you can do is, I joke that you can find a deal at breakfast and fund it by lunch. You probably should give it more thought, but
do a little bit more due diligence maybe, but yeah,
a little bit, but you could if you want. I mean, all you need to do is send the information, the wiring information to the bank and send the money. And then you sign the paperwork yourself. And it's pretty simple. The cool thing with checkbook control, because it's not held at a custodian, there's not as much administrative work to be done by the custodian. So they actually don't charge you as much. They're typically going to be charging like a flat fee somewhere in the range of $200 to $300 a year instead of $500 to $700 to $100,000 a year. So it really reduces the amount, the overhead costs, as well as the administrative burden you have to deal with.
Yeah. And I have one of each, and we have a decent custodian in our custodial account. And so we only had to do one deal with them so far. And that one just went full circle. So we actually have a lot more money in that account. And so I was not aware, I guess, or hadn't remembered the fees because we set it up a couple of years ago. So I'll have to double check that. Yeah. But yeah, I mean, it's very, the checkbook is very simple. I literally, found a deal, was like, yeah, this looks interesting. And you just, submit it just like a normal account. Now there is a caveat that you can't be active in the deal, right? You have to be 100% passive. So you can't actually be a general partner on the deal. So maybe talk through that, because obviously you're more knowledgeable than I am.
Yeah, that's a great point. And that's honestly why I ultimately landed on multifamily for my own retirement accounts. Because one of the main rules for investing with a retirement account is that it has to be invested in passive activities. It can only earn passive income. The example I like to give is like you could buy an Airbnb with your IRA if you really wanted, but you can't physically interact with that property. You can't go to the site and work on the property yourself. Somebody else would have to, because you're imparting help to your IRA. And then you also can't rent it from your IRA, because either you could rent it for $1 and you could gain a lot of benefit from your IRA's help, or you could rent it for $10,000 a night and get around contribution limits and pump a lot of money into your IRA. So there's no active income, no interaction with yourself. And so that also applies to like a multifamily deal. So if you are a general partner on an opportunity, you actually can't use your own retirement accounts in your own deal. That also extends for any like linear ascendants and descendants. So it's going to be parents and grandparents, the same rules in effect, children and grandchildren as well. So I run into this I'm trying to get my dad to retire at some point. He doesn't have retirement in his mind. I'm trying to move him to retirement. So I'm moving a lot of his investments into different passive opportunities. And he can't actually invest any of his retirement funds with me when I have a deal.
Oh, right. So if you have a
available.
deal, he can't actually invest with you or through you in that deal passively.
Yeah, exactly. So I find different sponsors for him to invest in. But that's fine. It's just something you have to look out for. That's one of the pieces that a custodian will offer is they have that oversight. So if you are an investor who is thinking of doing some things that are, more active and you plan on kind of dabbling in things beyond just passively investing, I would suggest a custodial account. But if you're planning on just investing as a limited partner in opportunities, I fully suggest a checkbook control account. If you're not related to anybody who's running the deal, you have nothing to worry about, really.
Got it. And then there is a tax, right? You're not subject to no taxes. There is a tax that is kind of comes along with these things. So can you talk a little bit about that, and how does that compare to, taxes for other types of accounts?
Yeah. So this is kind of like the large boogeyman that hangs over the space. If you ever look it up, you might see that there's a thing called UBIT. It's unrelated business income tax. And so what occurs is if you're investing in anything that is a leveraged investment,
meaning there's debt on the property, there's some type of loan. Yeah,
exactly. So the cool thing is you have the opportunity to invest in leveraged investments, which is phenomenal for your returns within your IRA. But the interesting thing is you're providing tax deferred capital to the deal, and an outside bank, like an outside source of capital, is bringing non-tax deferred capital to the deal. And so the IRS says this is totally fine. You can benefit from this, but you do have to pay tax on the portion of income that is earned by that non-tax deferred money coming from a lender. So that income is called unrelated debt financed income, UDFI, and then you pay tax on that. And the tax is unrelated business income tax, UBIT. And so it's kind of like a scary topic because the IRAs use the trust tax table, and that thing goes up to 37%. So a lot of people believe you're going to get taxed out the wazoo and it's going to destroy your returns. And I had the same fear when I first started. A lot of people were, waving that boogeyman over my head and saying I shouldn't do it. So actually, before I got started, I built myself, and I now use it, and it's available to anybody. And I'll give them the link at the end. But I built a UBIT calculator, and so I wanted to kind of see what the effect was on my potential opportunities. So I run hundreds and hundreds of deals through this. That's how we kind of vet our opportunities to make sure they are retirement aligned. And for the most part, multifamily deals in general are phenomenal for your retirement account. They have enough losses and they spin off enough losses. The cool thing with this is you can actually use the, let's say it's a 75% debt finance deal.
Yep.
You can use 75% of the losses. So any kind of depreciation, operating and interest expenses, you can use all of that to offset the income. So it really helps to offset much of your tax burden in the end. And with all of those losses that come through, for multifamily at least, I've seen that through years 0 through 5, let's say 1 through 5, you don't actually have to pay taxes on any of the cash flow. There's always enough losses to offset the cash flow. It's typically going to be at the time of a capital event. So at the time of a sale, generally, is when you're going to be seeing your UBIT total. And overall, it varies quite a bit. It can go up and down by about 5 to 10%, but I've seen an impact on an annual basis of about 12%.
Got it.
So it's not the worst tax in the world. It's unfortunate you have to pay a tax, but the cool thing is if you're able to get 20% annual returns on an investment, maybe you can, maybe you can't. It ultimately brings it down to like a 17.5% return.
Yeah. The opportunity outweighs the tax cost, if you will. So that makes sense. So if you're a W-2 employee, if you can go back and think about, you being back as a W-2, and you want to get started in your passive investing journey, what do you think is like a good first step? Like just to kind of, you maybe you've listened to this podcast or you've read a book and you're like, okay, I got to figure this out, but I love my job. I make a lot of money. I don't want to quit, but I'd love to have some extra passive income on the side to maybe go on a better vacation or put my kids through college or, whatever they want to do to kind of have build a little bit more of a financial foundation. So what's a good like first step, do you think?
Yeah. So the interesting thing about retirement accounts is if you have that goal in mind where you want to kind of have more passive income in your day-to-day life, your retirement accounts aren't going to do it for you because you don't have access to them.
Right. You can't touch that cash.
Yeah. Unless you want to pay a 10% penalty and then pay income tax if it's not a Roth account, you can't access that capital until you're 59 and a half. Yep. So it's a great idea for, helping yourself down the line.
Building more of a retirement stable, but not for active passive income that you can use on a daily basis.
Right. So if you're looking for active passive income, if you're looking for passive income that'll affect your current everyday life, in terms of like getting started, for education, this is the right place. I got started listening to podcasts and watching webinars and just educating myself as much as possible. But in terms of like the types of investments, I found the most interesting, and everybody's risk profile is completely different, but I really enjoyed investing in deals that were a little more deep value add because there is a lot more risk to it. The returns are a lot higher. I was young at the time, still am, but I had the opportunity to really recover from any kind of risk adjusted losses that might occur. But the really cool thing was I got to see, because when you're a passive investor, you get full insight and transparency into the opportunity. I was able to see what was going on with the property and what it took to renovate a property. From nuts to bolts, to tear it down to the studs. And I really got a good understanding of what went on at different properties. You may not want to bite off the biggest bone you can chew right away, but it was right for me. And it was a great insight into the whole world of multifamily and what the potential opportunities were.
Got it. No, that makes sense. And we're recording this in early February of 23. So, we're in a high interest rate environment. Inflation is stabilizing. So they say. They're talking about recessions, people losing jobs. Like, what's your 2023 outlook? Are you still a buyer in this market? Like, what are you telling your investors? Like, let's talk a little about the economy and what's going on.
Yeah, it's really interesting. We're at a time where there's like 15 things pushing in one direction and then 10 things pushing against it. Like, some things say recession, some things say, no, unemployment's low. We're on a tear. So it's all over the place. Where we end up ultimately, I don't think anybody has a clue.
Yeah, nobody knows what the tipping point is going to be, right?
Right. The great thing about the current interest rate environment is it's finally stabilizing. They're starting to slow down. They're tapering their interest rate hikes, and that's the ultimate thing we need when it comes to acquiring properties. It was really difficult in 2022 to acquire properties right in the middle of all of those hikes because there was so much uncertainty and volatility that our lending and debt terms were changing rapidly as we approached closing. And I saw it foul up deals. It threw everything all over the map. I don't mind paying a higher interest rate if we understand what's going to happen by the time we close, if we understand what's going to happen while we're actually, operating the property. If there's more stability surrounding that, I don't have any problem. Like, interest rates aren't at such a dramatically high price that I think it's prohibitive to purchase. I think there's going to be some opportunities with, if you have a bridge debt that this is a little more technical. If you have bridge debt that's going to be expiring around this time and you're forced to refinance at that point, you're looking at an opportunity there where you might not actually have the ability to refinance on a property if your NOI doesn't support the whatever lending requirements there are in today's market. So I think I don't think there's going to be a glut of them. I think there will be a decent supply of, you can call them distressed properties, not properties that are in bad shape, but just the seller
seller's more distressed.
Yeah, the seller is the more distressed person there. So some opportunities where you're going to be seeing decent properties that the current owner just isn't allowed to own it anymore by the lenders.
Yeah, I actually had a broker reach out to me this morning with like 3 or 4 deals. He was like, hey, can you take a look at these in San Antonio? And I was like, well, one of these sold last year. I know that. And so I think they're, and obviously when you underwrite deals 2 years ago or even a year ago, nobody knew that interest rates were going to go this high, this fast, right? So, you may have assumed a 2-point increase or, half a point, whatever the number is. Nobody anticipated this. So your underwriting is a little bit off. And so I think the same thing. I think deal flow is going to be a little slower this year. I think there's going to be some opportunities to get in and get some deals that people overbought, right? They were overpriced, especially if you bought it in 21, you definitely overpaid for what their value is now. So I think it's going to be interesting kind of as we come out of this over the next 6-8 months to see what actually transpires and how many deals are out there and all that. But I think I would love to be a buyer in the sense that, interest rates are automatically going to come down theoretically in the next couple of years, right? Or at least stabilize. So, what's the saying? You marry the house, you date the rate kind of a thing. So I feel the same way about multifamily at this point. So we're going to come into the ending here and kind of go through a couple of final questions. So I've got a 3-pack of questions that I ask every guest. So what is the one piece of advice that you got when you started or helped you kind of during your real estate journey?
The thing that's been the most effective for me, and I don't know how well it'll translate for passive investors. It was when I started to focus on one thing in particular. That's when I saw the most growth and change for myself. As I mentioned kind of at the start, I was thinking maybe I'd wholesale, maybe I'd flip, maybe I'd buy a single, a duplex, who knows? And when I had my attention on so many different things, I really couldn't fully dive into just one specific topic, master it, and then grow from that. So when I started focusing specifically on multifamily, and then when I started specifically focusing on building this retirement account knowledge business and helping people understand it, I saw a lot more growth because my focus, I could learn 100% about one thing. And once I mastered that topic, I was able to move to the next thing. And then I can start to work on mastering that as well. Going one at a time, I think, is a much more manageable approach to not just the real estate world, but really any kind of tactic you take in life.
Yeah, when my wife and I first got started in this whole real estate journey, we bought our duplex in mid 2019, and then we started listening to Bigger Pockets, and every episode there's somebody that's very successful in a niche of real estate, whether it's single family or short-term rentals or whatever. And so we chased the shiny object for like 6 months. We went after mobile home parks and, all this stuff. And so, then I was like, okay, I need to focus or I'm never going to become a good investor. And so that's when we narrowed in on multifamily. So, I totally agree with this, like being a little bit more narrow is going to help you to kind of get farther faster, essentially. All right. Question 2. What is your favorite real estate or business book right now?
So the business book that I liked the most was this thing called Blue Ocean Strategies.
Okay.
It's an interesting concept that basically says there are red markets and there are blue markets, like blue oceans. The red ones have a lot of sharks in the water. There's a lot of blood. There's too much competition. It's essentially a market that's kind of like toothpaste. You can't really revolutionize toothpaste. And so everybody's kind of competing at the lowest cost. They're all, competing for the same customers. We all need toothpaste. You can't really grow that market. So there's not a lot of profit to be made there. So the Blue Ocean Strategies and the book centered around finding opportunities where you can create your own concept of something and maybe bring together 2 different markets of customers into one, your new avenue. And so the group that they kind of base this around was like Cirque du Soleil. Okay. So Cirque du Soleil kind of brought together both the circus, ballet, and maybe even opera. And they brought together all these people who maybe wouldn't have previously gone to a circus. And now they're coming to a circus, and people in a circus who weren't looking at performative arts. And so they were basically able to bring together an even larger customer base. And so when I started looking at that for my own business, it was really cool because I could look at like what are, the different opportunities I have to kind of bring together people who wouldn't have already been investing in real estate. And it gives you a lot of thinking to do. Sure.
No, that's awesome. That's a great book. I hadn't heard of that one. So if you hit your financial freedom number, meaning you could kind of have an amazing life just living off of your passive income from investments, what would you do?
I don't know if it would take up all my time, but the first thing that comes to mind is skiing. Okay. I love it. It's one of my whys, I'd say, the ability to kind of, skiing, it's pretty popular at this point. And so it gets really busy on the weekends. A lot of people who work during the week take to the slopes on Saturday and Sunday. And so the ability, the first thing I noticed when I started real estate was the fact that I was able to go up into the mountains on like a Monday or Tuesday or Wednesday. And
Yeah.
so a dramatic change in what my experience was like, because I had the whole mountain to myself at times. And so the entire world, and it's not just when it comes to skiing, it's this opportunity to kind of live life at completely different hours from the rest of society. Like the world's getting very busy and there's a lot of people around. And so when you start to go to the grocery store and you're shopping with all the senior citizens, and it's a completely different picture. So just that time freedom of being able to like ski and pursue my own, passions, I think is what I do.
Yeah, no, being an entrepreneur, it's a blessing and a curse being able to kind of set your own schedule sometimes, right? Because sometimes you're like, ooh, I want to like watch the World Cup when it was on, a few months ago. And it's like really great because I just like blocked meetings and all that stuff. So no, I totally appreciate that. So, thanks, man, for coming on. I really appreciate it. What's a good way for people to get in touch with you? And we'll put all your socials and everything in the show notes, but what's kind of the best way to reach out if they have any questions?
Yeah. People can find me at walltomain.com, like Wall Street to Main Street. And I have a bunch of education surrounding the self-directed retirement space. And then if you're interested in that UBIT calculator, I built one for limited partners to understand what the potential tax might be on their projected returns. And so you can get that at UBIT calc.com.
Awesome. Thank you, Josh. I really appreciate it. And hope everyone took something away from this episode. I've got another one dropping very soon, so keep listening. Remember, you don't have to quit your career to build a passive real estate portfolio that provides you with multiple streams of passive income. You just need to take some action, and listening to this podcast is a great, awesome first step. So thanks for joining, and appreciate you coming on.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast. Your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.